Well, I'm joined by Michael Treherne. He's a portfolio manager at Vestac. Thanks very much for joining us, as always, sir.
No, always fun to be here.
Good stuff. Now, we've heard about Moody's downgrading China for the first time in nearly 30 years. It's citing concerns about an economy-wide rising debt situation. Yet we know that the Chinese authorities have actually been trying to diminish that problem by increasing interest rates and so on and so forth. Is Moody's not a little bit behind the curve? And they're also anticipating that China will grow at about 5%, which is great by most countries' view. So what do you think about this, and how has it impacted global markets, if at all?
Yeah, so I think the one point you made, that Moody's is probably a bit behind the curve, is I'd say fairly accurate, given that they downgrade China's debt rating and the market did nothing. And it's saying that the market already knew this and was pricing in those risk levels. Having said that, they still have a very high rating when they're on the same level as the likes of Japan, so it's not a bad rating to be at. China's in the fortunate position that they are growing very quickly, and as you say, 5% is probably slow for Chinese standards, but very fast for global standards. And if you've got a debt burden and you're growing at 5, 6, 7%, you can quite quickly grow out of that if need be. There's a few years ago, people were talking about ghost cities in China, where the Chinese would just go and build cities to get spending out the way, to stimulate the economy, but no one would ever be in there, and that would lead to this massive implosion. But you fast forward 2-3 years, and those ghost cities are now being inhabited by people, where people are moving out of some very busy cities, out of the rural areas, moving into these cities that have already been built, and now stimulating the economy that way. So I think China's still on the right track. Their debt downgrade isn't anything huge. Market dropped slightly as soon as the news came out, but then it recovered, so as we were.
There is a perception that the ratings agencies are somewhat harsher on emerging markets relative to developed markets. I mean, if you look at the US, I mean, its debt situation is hardly looking rosy. Why is it that there seems to be this different approach to the different type of economies?
Yeah, it comes down to risk again. So if you look at the US has quite a big debt burden, but their debt compared to the revenues that they collect from taxes, compared to the assets that the government own, assets that private individuals own, it's very manageable. Added to that, the interest rate that the debt's paying is very low, which makes higher levels of debt more sustainable. So the US is paying 1% on their debt, where many emerging markets are paying closer to 7-8%, and that comes down to the risk factor again. In the US, things have been stable. You're fairly sure that if you lend the US government money, you're going to get it back, whereas if you're lending money to an emerging market, China, for example, maybe a bubble bursts, maybe they don't grow at 5% and only grow at 1%, which would be a huge problem for the debt market. You look at South Africa, do we lend South Africa money? What happens if political turmoil comes? If there's a change in policy, will we get our money back? We're not sure. So because of the uncertainty, you have to charge a higher interest rate to account for that risk. So developed markets, a lot less risky, a lot less volatile, a lot more established, therefore lower risk, lower interest rates. Emerging markets still trying to figure their way out in the globe, a lot more risk, therefore you need a higher risk premium, and that's why the rating agencies rate you as they do.
Okay, nicely explained. Thank you for that. And then April CPI here at home, it slowed much more than expected, rising by 5.3% year on year in the month of April. Now, that's boosted the rand, but of course the question that I posed in the intro is really, is that going to be sustained going forward? Because we know that oil prices are elevated, and the significant oil producers are looking to keep it elevated. And we know that the rand can just turn around and go back up to 14, depending on what Mr. Trump does.
Yeah, so look, I think it's great for the consumer, 5.3%. You look at the food category, veggies, fruit coming down quite significantly, meat and fish up, unfortunately, but I suppose out of the two, you'd rather have veggies cheaper. So Yes, that's good for the consumer. Travel expenditure not increasing by 6%, so that helps again. Having said all of that, inflation still hurts the communities, it still hurts the poor a lot. What will the Reserve Bank do later this week now that we're back in the range? I think probably leave it the same, have a look for another couple of months before they drop interest rates potentially. Oil prices, I still think $60 is probably your cap because the US is continuing to increase their production. The rest of the world is under pressure to try to drop their production to keep oil prices high. I don't think you have a problem there. Inflation, I think, under control. Let's see what the Reserve Bank forecast is this week.
Okay, let's do that. And then let's take a look at some results. Mediclinic International, which has interest in the UK, Switzerland and the United Arab Emirates, they came out with their full year results for the year ended March. Earnings per share down 19%, although the group saw revenue rise by 30% at £2.5 billion, which sounds quite a lot. I kind of think that your healthcare type of stocks are like food stocks. You can't go wrong with them because people will always need those. What do you think of it?
Yes, it's something that we like at Vestact. It's something that we've been investing in. Like you say, healthcare is one of the things that people are going to need. It's something that you don't skimp on. And as global populations age and as global populations get richer, one of the key areas they spend money is on healthcare. Looking at the group, they made an acquisition at the beginning of last year where they increased their stake in the UAE region. And that's the reason why you've seen such a big increase in their revenues, but a drop in profits because of the debt associated with buying that, with the issuing of shares. So it's still a bit of worries there because as they bought the company, the UAE came out and said, look, we're not going to 100% subsidize people to go to private hospitals, and their patient numbers then dropped. Subsequently, at the end of April this year, the UAE came out again and said, look, we're going to scrap that. I think let's go back to 100%. There's still a bit of uncertainty exactly how that's going to work, but that bodes well for them going forward. But the biggest part of their operations is still Switzerland, and having a look at their hotels I shouldn't say hotels, hospitals that look like hotels. It's a great place to be. Out-of-pocket spend anywhere in the world is the highest in Switzerland, and they're the key player there. I think it's 1 in 3 people who get admitted to hospitals go through a Mediclinic hospital. So we like it for the long term. Sounds pretty good. We're going to leave it there. We've run out of time, unfortunately. Thank you so much, Michael. Well, that was Michael Treherne, Portfolio Manager at Vestact. And after a short break, Nzinga will have more business news for you.